You're scrolling through your feed right now, and you're seeing it everywhere. 19-year-olds in rented Lamborghinis telling you that if you just buy their course, drop ship some plastic garbage from overseas, or trade the latest meme coin with funny dog pictures, you'll be a millionaire by next Tuesday. It's exhausting, it's insulting, and deep down you know it's absolute nonsense. But then you look at your own bank account. You see the price of eggs, the rent that just went up again, and that looming feeling that the American dream has been put behind a paywall you can't afford. You want to invest. You know you should invest. But the financial gurus tell you to stop buying lattes as if saving $5 a day is going to magically bridge the gap between you and a comfortable retirement in an economy designed to squeeze you dry. Here is the cold, hard reality that the financial industry doesn't want to say out loud because it's not sexy and it doesn't sell courses. You don't need a lucky break. You don't need to time the market. You don't need a massive inheritance. You need $25. And that sounds ridiculous, right? $25 is basically a decent lunch and a tip in a major city today. But what if I told you that this specific amount, applied with almost robotic consistency to a specific mathematical loophole in the market, is enough to build a portfolio worth $500,000? We are going to break down exactly how to weaponize the drip strategy. We aren't talking about gambling. We are talking about building a machine that prints money while you sleep, using the exact same tools the ultra-wealthy use to stay wealthy. Let's get into it. The problem isn't that you're bad with money. The problem is that the human brain is hardwired to fail at investing. We are evolutionary designed to hunt and gather, to react to immediate threats. If a tiger is chasing you, you don't think about compound interest over 30 years, you run. The stock market is designed to exploit this. It flashes red when you should be buying, scaring you into selling. It flashes green when you should be cautious, tricking you into buying at the top. Wall Street makes its money on your activity. They want you trading. They want you panicking. They want you paying fees. But the wealthy, they don't play that game. They play the role of the house in a casino. They own the assets that pay them just for existing. This is where the system has failed you. It taught you to work for money, but it never taught you how to make money work for you. You trade hours for dollars. That's a linear equation. If you stop working, the money stops flowing. We need to switch to an exponential equation, and the variable that changes everything is the Dividend Reinvestment Plan, or DRIP. Let's strip away the jargon. Imagine you plant an apple tree. In the first season, it gives you one apple. Most people take that apple and eat it. That's cash flow. That's spending your dividends. But the DRIP strategy is different. You take that apple, you pull the seeds out, and you plant them. Now you have the original tree plus a few saplings. Next season, the original tree gives you apples, and the saplings give you a few apples. You plant those seeds too. Fast forward 20 years, you don't have a tree, you have an orchard, and you didn't pay for the orchard paid for itself. In the stock market, this is called compounding, but that word is too boring for how powerful it actually is. Einstein reportedly called it the eighth wonder of the world, and he was pretty good at math. When you turn on DRIP, or automatic dividend reinvestment, you are telling your brokerage, do not give me cash. Take every penny of profit this company pays me and immediately buy more shares of that same company. This creates a feedback loop. More shares equal more dividends. More dividends buy more shares, which generate more dividends. It is a snowball rolling down a hill, getting heavy fast. But here is where the cynicism usually kicks in. You're thinking, okay, but I only have $25 a week. That snowball is going to be the size of a golf ball. Let's run the simulation. We are going to use real data, real market mechanics, and remove the hope factor. We are simulating a portfolio based on three specific types of fuel: the aristocrats, the yield beasts, and the growth engines. If you throw $25 a week into a savings account, in 30 years, accounting for inflation, you will have basically nothing. You will have lost purchasing power. But let's apply that $25 to a DRIP strategy. That's $1,200 a year. The first concept you need to understand is dollar cost averaging. This is your shield against market crashes. Since you are investing $25 every single week automatically, you don't care what the price is. When the market crashes and everyone is screaming on the news, your $25 buys more shares because they are on sale. You acquire more of the dividend-paying machine for cheaper. When the market is high, you buy fewer shares, preventing you from going all in at the top. You are mathematically smoothing out the ride. Now, let's build the engine. You cannot just throw this money at any random stock. If you chase a company paying a 15% dividend yield, you are likely walking into a trap. Usually, when a yield is that high, it's because the share price has collapsed because the business is dying. We need sustainability. We look for the dividend aristocrats. These are companies in the S&P 500 that have increased their dividend payouts for 25 consecutive years or more. Think about that. Through the dot-com bubble, the 2008 crash, the 2020 pandemic, these companies not only paid a dividend, they gave their investors a raise. We are talking about boring companies. We're talking about companies like Realty Income, ticker symbol O. They call themselves the monthly dividend company. They own thousands of commercial properties, convenience stores, pharmacies, grocery stores. They collect rent and they pass that rent to you. Let's say you start your $25 per week journey. In year one, it feels pathetic. You invest $1,200. Maybe you earn a 3% dividend yield. That's $36 in passive income for the whole year. You can't even buy a video game with that. This is where 90% of people quit. They say this isn't working, and they go back to buying lottery tickets or trying to day trade crypto. But let's look at year 10 in our simulation. You have invested $12,000 of your own money over a decade. But because you kept reinvesting those dividends and the companies kept raising their payouts and the stock prices appreciated, your portfolio isn't worth $12,000. Depending on market conditions, it could be worth $25,000 to $30,000. But the important part is the flow. You are now making hundreds of dollars a year in passive income that is automatically buying more shares. Now let's fast forward to year 20 and year 30. This is where the exponential curve goes vertical. The magic number we are aiming for is the yield on cost. This is a metric the gurus rarely talk about. Let's say you buy a share of Coca-Cola today for $60 and it pays a $2 dividend. That's roughly a 3% yield. Boring, right? But in 20 years, because Coke raises its dividend every year, that same single share might be paying out $10 a year in dividends. Since you only paid $60 for it originally, your personal yield on that money is now over 16%. You are earning 16% interest on money you spent 2 decades ago. And that is happening on thousands of shares that you accumulated using the DRIP method. So, how do we actually construct this $500,000 portfolio? You need a mix. You can't just bet on one horse. First, you need the foundation. This is 50% of your portfolio. These are the aristocrats, ticker symbols like J&J, Johnson & Johnson, PG, Procter & Gamble, or reliable ETFs like SCHD, which aggregates these solid companies for you. These don't make you rich overnight. They keep you from going poor. They provide the steady, reliable drip that keeps the machine moving. Second, you need the accelerators. These are high-yield stocks, often real estate investment trusts or business development companies, BDCs. Stocks like Realty Income or Main Street Capital. These guys pay out 5%, 6%, sometimes 7% yields. In a DRIP portfolio, these are your turbochargers. They generate cash fast, which buys more shares fast. You aren't spending this money, you are feeding it back to the beast. Third, and this is crucial, you need dividend growth. These are companies like Visa, Microsoft, or Apple. Their current yield is tiny, maybe less than 1%, but they grow their dividend by 10% or 15% every year. In decade 1, they do nothing for you. In decade 3, they're the ones that make you a millionaire. Here is the roadmap to turning $25 a week into financial freedom. Phase 1, the accumulation phase. This is years 1 through 7. This is the grind. You set up an automatic transfer. $25 leaves your checking account every Monday morning. You don't look at it. You set your brokerage app to automatically reinvest dividends.
You delete the app from your phone so you don't panic sell when the market drops. Your only goal here is to accumulate units of ownership. You are collecting houses on a monopoly board. Phase 2, the momentum phase, years 8 through 15. This is where you start to notice something weird. The dividends coming in are starting to buy entire shares on their own.
Suddenly, you aren't just buying shares with your $25, your portfolio is buying shares with its own money. The machine is coming alive. Phase 3, the compounding phase. Year 15 and beyond. This is where the math breaks reality. Your portfolio is generating thousands of dollars a month in dividends. If you hit that $500,000 mark, which is mathematically probable over a long time horizon with dividend growth and market appreciation, and you have a portfolio yielding 5% on average, that is $25,000 a year in cash. But remember, you kept buying. You didn't stop at $25. As your career advanced, maybe you bumped it to $50 or $100. The $500,000 number isn't a fantasy, it's a mathematical inevitability if you remove human error. The biggest threat to this strategy isn't a stock market crash, it's you. It's you looking at the account in year 3, seeing you only made $200 in profit and saying, "This is stupid, I'm going to buy options on a tech stock." It's you seeing a recession on the news and pausing your $25 weekly contribution out of fear. To make this work, you have to be robotic. You have to view that $25 as a tax you pay to your future self. There are specific ETFs that can do this for you if you don't want to pick individual stocks. Look at funds that focus on dividend growth or high dividend yield. These funds automatically rebalance, selling the losers and buying the winners, so you don't have to spend your weekends reading balance sheets. But let's get real for a second. The system wants you to be a consumer. It wants you to spend that $25 on streaming services you don't watch or fast food that makes you sick. They're betting on you staying poor. They're betting on you lacking the discipline to wait 20 years. The drip strategy is the ultimate rebellion. It is boring, it is slow, it is unsexy, and it is absolutely devastatingly effective. You can start this today. You don't need a financial advisor. You don't need a license. You need a brokerage account, a bank link, and the discipline to click Auto Invest and then walk away. Don't let the simplicity fool you. The Grand Canyon was carved by a river, drop by drop over millions of years. Your wealth is built the same way, drop by drop, dividend by dividend. Stop looking for the lottery ticket. Build the machine. If you want to dive deeper into which specific sectors manage to keep paying dividends even when the economy is in the toilet, or how to spot a dividend trap before it blows up your portfolio, keep your eyes on this space. We're going to be tearing down the financial jargon and showing you exactly how the sausage is made. But for now, take that $25, pay yourself first, and let the snowball roll.